Hello everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. In today's video, we look at 10 key lessons on investing that Morgan Stanley's equity team has learned from over the last 20 plus years. These lessons are very useful reminder whether you're an experienced investor or whether you're a newbie investor. Before we get started, please smash that like button so others can find this video as well. So let's dive in. Lesson 1. Pick great stocks and don't interrupt compounding. Focus on picking high-quality companies with high returns on invested capital and low validity of margins, strong pricing power, and low leverage or debt. These companies can grow their top lines and free cash flow steadily and are more likely to compound wealth. Lesson 2. Know what you own. It is important to stay within one circle of competence and understand the business models for companies you own. It is especially important when the markets take a downturn and there is a massive selling going on. You need to have the confidence in the companies you own, and that comes from knowing them in depth. Lesson 3. Trust your instincts on management. Who is running the companies you own is of the utmost importance. Try to understand how the management thinks and whether they have long-term perspective. Also, founder-based companies are likely to tackle challenges better than the non-founder-led. Lesson 4. Benchmarks are risky. While it is important to have some way of measuring progress or success, but benchmarks can be risky because benchmarks do not care about price or quality and are usually a mixed bag of businesses. Lesson 5. Risk management is critical and must be absolute. Risks should not be relative, but must be absolute. Absolute risk means the chance of losing your entire investment. This must be carefully studied and avoided. Lesson 6. What you don't own is just as important as what you do. Based on your investing style and your goals, certain sectors or certain types of companies can better be avoided. Don't get distracted by short-term performances and a fear of missing out, which is also called as FOMO, instead of focusing on long-term compounders. Express your conviction in your concentrated position sizes is what Lesson 7 talks about. Make sure your conviction in a company is reflected in the portfolio. This means you have high conviction in some company. Give it higher weightage in your portfolio. Lesson 8. Valuation matters always. Even great companies are not great investments if you overpay. Valuation always matters. Focus on free cash flow instead of earnings, as cash is real. Even if some company stock is too expensive right now, be patient. Most things you want to own eventually will come your way. Lesson 9. Maintain a long-term perspective. Trying to beat the market every year is futile. What matters is winning across long-term cycles. Lesson 10. Remain curious. Yes, the secret to being a good investor is to remain curious, asking the right questions, digging deeper into business models, exploring and understanding how businesses works. Don't give up on that. So, that's it for now from all of us here. Be sure to smash that like button, and thanks for watching and subscribe for more. Bye-bye.